Chapter 1. Foundations of Success. The Trader's Weekend. The weekend is a period of calm after the storm of the trading week. For a beginner trader, this quiet time is not just an opportunity to rest, but also a chance to lay the groundwork for the challenges of the coming days. In the financial markets, preparation is everything. Success is not determined by the hours spent staring at charts, but by the clarity of thought and discipline a trader cultivates. This chapter explores how to use Saturdays and Sundays effectively to prepare for a consistent, profitable trading week. The role of rest and balance in trading. Trading is one of the most mentally taxing activities a person can undertake. It requires quick decision-making, emotional resilience, and the ability to process complex information under pressure. Without adequate rest, your mind becomes your biggest liability, sabotaging your trading decisions. 1. Why rest matters. Sleep is vital for maintaining sharp cognitive function, emotional stability, and decision-making ability. Studies in neuroscience have shown that sleep deprivation impairs the prefrontal cortex, the part of the brain responsible for rational thinking. Rest days help reset your mental state, reducing the risk of burnout and enabling you to approach the markets with a clear mind. 2. Rest against laziness. Resting doesn't mean avoiding all productivity. Instead, use your downtime to engage in activities that rejuvenate your mind and body, like light exercise, hobbies, or spending time with loved ones. 3. The power of detachment. Constantly thinking about the markets, even on weekends, can lead to obsessive behaviors that degrade your performance. Professional traders know the importance of stepping away to gain perspective. Action plan for Saturday. Sleep in if needed, ensuring you get at least 7 to 8 hours of sleep. Avoid checking your trading platform or obsessing over past trades. Engage in activities that bring joy and relaxation, such as hobbies, outdoor walks, or spending time with family. Saturday evening, reflect and analyze. Once you've rested, it's time to reflect on the previous trading week. This process is critical for growth and self-improvement as a trader. 1. Review your trading journal. A trading journal is your personal roadmap for improvement. It should include the trades you took and their outcomes, the rationale behind each trade, emotional observations, how you felt during and after the trade. 2. Ask the right questions. What went well and why? What mistakes did I make and how can I avoid repeating them? Did I follow my trading plan or did I deviate due to emotions or external influence? 3. Focus on process, not outcomes. Beginner traders often measure success solely by their profit and loss statement. This is a mistake. Instead, evaluate whether you followed your trading strategy with discipline. Over time, good processes lead to consistent profits. Pro tip: avoid overanalyzing. Focus on extracting 1 to 2 key lessons from the week to improve gradually. Sunday, building your game plan. While Saturday is about reflection, Sunday is about preparation. Markets may be closed, but the groundwork you lay on this day will determine the quality of your trades during the week. Step 1. Study the economic calendar. Professional traders emphasize the importance of understanding macroeconomic events that could impact the markets. 1. What is the economic calendar? This is a schedule of upcoming economic releases, such as employment data, central bank meetings, and GDP reports. These events often trigger significant market volatility. 2. Key events to watch for: non-farm payroll reports, interest rate decisions by central banks, geopolitical news such as elections or trade agreements. 3. Plan around news events. Decide in advance whether to trade around high-impact news or avoid it entirely. Beginners often struggle with the unpredictability of news-driven markets, so staying on the sidelines during major events can be a wise choice. Step 2. Perform a technical analysis. Sunday evenings are ideal for analyzing weekly and daily charts to identify key market levels and trends. 1. Focus on higher time frames. Begin with the weekly chart to spot major trends, support, and resistance levels. Move to the daily chart for a closer look at recent price action. 2. Define potential setups. Mark areas of interest. Identify trends. 3. Avoid overcomplicating. Beginner traders often clutter their charts with too many indicators. Stick to 1 to 2 tools, such as moving averages or Fibonacci retracements, to keep your analysis clean and actionable. Step 3. Set weekly goals. Clear, measurable goals will keep you focused and disciplined throughout the week. 1. Process-oriented goals. Example: I will only take trades that align with my plan. Example: I will review each trade in my journal immediately after closing it. 2. Avoid unrealistic expectations. Aiming to double your account in a week is a recipe for disaster. Instead, focus on consistency and risk management. Step 4. Plan your trading hours. Professional traders treat trading like a business. Part of that involves establishing a consistent schedule. 1. Choose your sessions wisely. Identify which trading sessions align with your lifestyle and strategy. If you're trading part-time, focus on 1 to 2 sessions per day to avoid burnout. 2. Set boundaries. Decide when to start and stop trading each day. Overtrading is a common mistake among beginners, leading to fatigue and poor decisions. Sunday evening, mental preparation. Before the week begins, spend time visualizing the trader you want to be. 1. Practice visualization. Picture yourself following your plan with discipline. Imagine yourself staying calm during market fluctuations, sticking to your strategy, and managing losses gracefully. 2. Affirmations for success. I trade with patience and discipline. I follow my strategy regardless of the market's noise. Losses are part of the process, and I will learn from TTM. Why weekend preparation matters. Beginner traders often focus solely on the hours when markets are open, neglecting the importance of preparation. However, it's the work you do during the weekend, resting, reflecting, and planning, that separates amateur traders from professionals. By using Saturday to recharge and Sunday to prepare, you enter the trading week with clarity, confidence, and a defined strategy. This foundation will help you avoid impulsive decisions, manage risk effectively, and build the consistency required for long-term success. Remember, trading is not about chasing every opportunity, but about executing your plan with discipline and patience. The weekend is where that plan begins. End of Chapter 1. Chapter 2 will focus on how to navigate the trading week itself, including handling emotions, avoiding overtrading, and maintaining balance between trading and life. Chapter 2. Mastering the Trading Week, from Monday to Friday. The trading week is where preparation meets execution. Many beginner traders stumble here because they lack structure, discipline, or the ability to adapt to changing market conditions. This chapter will guide you through each day of the trading week, offering strategies to help you stay focused, maintain balance, and build habits that lead to long-term success. Monday, setting the tone. Monday often sets the psychological tone for the rest of the week. Many traders make the mistake of rushing into trades without considering the context of the market's behavior after the weekend. 1. Ease into the markets. The markets can be unpredictable on Mondays as institutional traders adjust their positions based on weekend news. Avoid jumping into trades during the first few hours unless there is a clear, high-probability setup. Use Monday as a reconnaissance day to observe how the market reacts to key levels identified in your weekend analysis. 2. Stick to your plan. Avoid starting the week with impulsive trades. Many beginners lose discipline on Monday, setting a negative tone for the rest of the week. Focus on executing only setups that meet your predefined criteria. 3. Emphasize emotional discipline. If you experience a loss on Monday, take it as a lesson and avoid revenge trading. A single loss doesn't define your week. Reflect on whether the trade aligned with your plan or if emotions played a role. Key tip for Mondays: limit your trades to 1 or 2 high-quality setups. This allows you to start the week cautiously, without overexposing yourself to unnecessary risk. Tuesday to Thursday, peak trading days. These 3 days are often the most productive for traders, offering the best liquidity, volatility, and trading opportunities. This is where you execute the majority of your trades. Establish a daily routine. A consistent routine is crucial for maintaining focus and avoiding burnout. Here's a recommended structure. 1. Morning. Review your trading plan and the economic calendar for the day. Perform a quick analysis of the market's overnight activity if you're trading a different session. Set mental intentions for the day. I will trade only when conditions align with my plan. 2. During the trading session. Focus on quality, not quantity. Beginner traders often feel the need to overtrade, but professionals know that fewer well-executed trades yield better results. Stick to 2 to 3 trades per day at most. This reduces emotional fatigue and prevents impulsive decision-making. 3. After the session, log your trades in your journal, noting what went well, what didn't, and any lessons learned. Step away from the charts to recharge. Engage in non-trading activities like exercise, reading, or spending time with family. Navigating different trading sessions. 1. London session. The London session is often the most liquid and volatile, making it ideal for trend-following strategies. Focus on pairs that involve the euro, pound, or Swiss franc. 2. New York session. The New York session overlaps with London for a few hours, offering excellent trading opportunities. Be cautious of midday slowdowns and increased volatility near the close of the session. 3. Asian session. The Asian session is generally quieter, with smaller price movements. It's ideal for range trading strategies. Friday, closing the week. Fridays can be tricky. Liquidity often dries up toward the end of the day as traders close their positions ahead of the weekend. 1. Trade conservatively. Avoid taking new trades late on Friday. The market may exhibit erratic behavior as traders close out positions. If you're in an open position, consider closing it to avoid weekend gaps. 2. Weekly review. Spend Friday afternoon or evening reviewing your trading journal and assessing your week's performance. Reflect on the following. Did I follow my plan? What were my biggest strengths this week? What areas need improvement? Key tip for Fridays: treat Friday as a wind-down day. Focus more on reviewing and less on trading, handling losses and wins. Success in trading isn't about avoiding losses, but about managing them. Likewise, celebrating wins can be dangerous if it leads to overconfidence. Here's how to handle both. 1. After a loss, accept it as part of the game. Even the best traders experience losses. Analyze the loss. Was it due to poor execution, bad luck, or deviation from your plan? Take a break if needed. Trading immediately after a loss often leads to revenge trading. 2. After a win, stay humble. A win doesn't mean you're invincible. Review the trade to ensure it was aligned with your strategy. This reinforces good habits. Avoid increasing your position size or taking unnecessary risks out of overconfidence. Maintaining balance during the week. Trading is demanding, but balance is crucial for sustained success. Here's how to ensure you remain sharp throughout the week. 1. Exercise regularly. Physical activity improves cognitive function, reduces stress, and enhances emotional resilience. Even a 20-minute walk can help clear your mind and improve focus. 2. Engage in hobbies. Activities like reading, cooking, or playing an instrument can help you decompress after a trading session. 3. Limit screen time. Staring at charts for hours on end doesn't make you a better trader. In fact, it increases fatigue and emotional impulsivity. Set specific times for analysis and trading, and stick to them. 4. Practice mindfulness. Techniques like meditation or deep breathing can help you stay calm and focused, especially during volatile markets. The importance of sleep. Sleep is non-negotiable for traders. Poor sleep affects judgment, reaction times, and emotional control, traits critical for successful trading. 1. Establish a sleep schedule. Go to bed and wake up at consistent times, even on weekends. Aim for 7 to 8 hours of quality sleep per night. 2. Avoid midnight chart checks. Beginner traders often wake up during the night to check their trades. This disrupts sleep patterns and leads to emotional trading. 3. Create a sleep-friendly environment. Keep your bedroom dark, quiet, and cool. Avoid screens for at least 30 minutes before bed to reduce blue light exposure. Staying strong and avoiding burnout. Trading can be emotionally draining, but mental resilience is key to long-term success. 1. Recognize signs of burnout. Constant fatigue, lack of motivation, and emotional trading are common warning signs. Take breaks when needed. Stepping away for a day or two can often reset your mindset. 2. Build a support network. Trading can be isolating, so connect with like-minded individuals through forums or trading communities. 3. Avoid external noise. Social media is filled with traders posting unrealistic results. Focus on your own journey and ignore external distractions. Conclusion: discipline is the key. The trading week is not just about making money, it's about building habits, refining your process, and staying disciplined. By structuring your days, managing your emotions, and maintaining balance, you create an environment for consistent growth and success. Remember, trading is a marathon, not a sprint. Approach each week with patience and a commitment to improvement, and you'll be well on your way to mastering the markets. End of Chapter 2. In Chapter 3, we'll dive into how to stay consistent in the long run, deal with setbacks, and cultivate the mental toughness needed to thrive as a trader. Chapter 3. The Art of Consistency and Resilience in Trading. Consistency and resilience separate successful traders from the rest. The financial markets are full of uncertainties, and mastering your mindset, habits, and long-term strategy is crucial. This chapter explores how to stay disciplined, deal with setbacks, build a sustainable routine, and strengthen your mental and emotional resilience. Consistency, the cornerstone of success. The key to becoming a successful trader lies in your ability to be consistent, not just with profits, but with following your plan, maintaining discipline, and sticking to routines. Set clear goals. Define success. Beyond profits, success isn't just about hitting a profit target. It's also about following your trading plan, learning from mistakes, and improving your process. Break down weekly objectives instead of focusing solely on long-term results. Set smaller, achievable goals for the week. For example, execute only high-probability trades. Avoid overtrading. Journal every trade, win or lose. Focus on process over outcome. Traders often get fixated on profits, but the real measure of success is how well you stick to your plan. A loss from a well-executed trade is better than a win from a reckless one. Avoid emotional highs and lows. Winning doesn't make you invincible, and losing doesn't make you a failure. The power of routine. A structured routine creates stability in an otherwise chaotic environment. Design your day with these components. 1. Morning preparation. Review market news and economic events for the day. Meditate or engage in light exercise to sharpen your focus. Set your trading intentions for the day. 2. During trading hours, stick to a specific trading window. Avoid trading 24/7. It's neither healthy nor effective. Take breaks between trades. Step away from your desk to recharge mentally. 3. Evening reflection. Review your trades and journal your observations. Disconnect from the market. Spend time on hobbies, family, or personal growth activities, dealing with setbacks, losses, drawdowns, and emotional pain. Losses are inevitable in trading. The difference between successful and struggling traders lies in how they handle them. After a loss. 1. Acknowledge it. Accept that losses are part of trading. Even the best traders lose money regularly. Avoid blaming the market. Instead, ask yourself, was the trade aligned with my plan? Did I follow my risk management rules? Was the loss due to market conditions or my mistake? 2. Pause before moving on. Take a break after a loss to reset emotionally. Trading immediately after a loss often leads to revenge trading. 3. Learn from it. Log the trade in your journal and identify areas for improvement. Focus on the process, not the outcome. If the trade was well executed, you've done your job. After a string of losses, reduce risk temporarily. If you're in a drawdown, lower your position size to protect your capital. Reassess your strategy. Review your recent trades to identify patterns or mistakes. Are you deviating from your plan? Are you trading during low probability setups? Avoid emotional trading. Take a day or two off if needed. It's better to pause and reassess than to continue trading in a reactive state. After a win. 1. Stay grounded. Winning can be as dangerous as losing if it leads to overconfidence. Stick to your plan and avoid increasing your risk impulsively. 2. Celebrate small wins. Recognize your efforts, but don't let emotions cloud your judgment. Acknowledge the win, log it in your journal, and move on. Mental health and trading, recognizing and addressing challenges. The pressures of trading can take a toll on your mental health. Recognizing and addressing these challenges is vital for long-term success. Common mental health issues in trading. 1. Stress and anxiety. The constant pressure to perform can lead to heightened stress levels. Solution: incorporate stress-reducing activities like meditation, yoga, or exercise into your daily routine. 2. Burnout, overtrading, lack of sleep, and excessive screen time can lead to physical and mental exhaustion. Solution: take regular breaks, set trading hours, and engage in non-trading activities to recharge. 3. Isolation. Trading can be lonely, especially if you work independently. Solution: join trading communities or forums to connect with like-minded individuals. 4. Emotional turmoil. Losses and drawdowns can lead to frustration, self-doubt, or even depression. Solution: seek support from mentors, friends, or mental health professionals if needed. Practical tips for mental resilience. 1. Maintain a balanced lifestyle. Prioritize sleep, nutrition, and exercise. A healthy body supports a sharp mind. 2. Practice mindfulness. Techniques like deep breathing or meditation can help you stay calm and focused, even during market volatility. 3. Seek professional help if needed. If trading is affecting your mental health, don't hesitate to reach out to a therapist or counselor. Staying strong, overcoming challenges, and staying the course. Trading is a journey filled with ups and downs. Staying strong requires patience, determination, and the ability to adapt. Avoid the comparison trap. Social media is filled with traders flaunting exaggerated or fake results. Comparing yourself to others can lead to self-doubt and impulsive decisions. Focus on your own progress. Trading is a personal journey, and everyone's path is different. Stick to your strategy. Constantly changing strategies based on short-term results is a common beginner mistake. Commit to a well-researched strategy and give it time to prove itself. Find your trading rhythm. Identify the time of day or week when you perform best. For example, some traders excel during the London session, while others prefer the New York session. Stick to a consistent schedule to build familiarity and confidence. The importance of perseverance. Trading is not a get-rich-quick scheme. Success requires years of practice, learning, and refining your skills. Here's how to stay motivated during tough times. 1. Celebrate progress. Recognize small milestones like sticking to your plan for a week or improving your trade journaling. 2. Revisit your why. Remind yourself why you started trading. Whether it's financial freedom, passion for the markets, or personal growth, keeping your purpose in mind can keep you motivated. Embrace failure as a teacher. Every loss or mistake is an opportunity to learn. View setbacks as stepping stones to success. 4. Surround yourself with positivity. Build a network of supportive individuals who encourage and inspire you. Conclusion: building a legacy in trading. Trading isn't just about making money. It's about building a skill set that can sustain you for a lifetime. By staying consistent, managing your mental health, and maintaining balance, you position yourself for long-term success. Remember, every great trader started where you are now. The difference lies in perseverance, discipline, and the willingness to learn and adapt. Stay focused on the process, and the results will follow. The journey is yours to take, one trade, 1 week, one lesson at a time. End of Chapter 3. This concludes the 3-part guide on how to structure your week as a trader, maintain balance, and build resilience. With these principles in mind, you're equipped to approach the markets with confidence and clarity.